All right, fantastic. Welcome everyone to tonight's session on tax planning 2020. My name's Drew. I'm here today with Simon, Ben, Christine and Mike. And I suppose probably should introduce myself a little bit. So I'm a director here at Munros. I like to go around and say that I like helping ambitious business owners make more profit, pay less tax, and live more meaningful, happier lives. I think that's incredibly important, the last part in particular, the happier lives. And that's why I'm currently participating in the push-up challenge also to help raise awareness for mental health support. I've got about 700 push-ups to go up to this Sunday, but plenty more to do today after the webinar, unfortunately. So what I'm going to do is I'm just going to turn off the video there. Just so we can all focus on the slides. And just a little bit of a spill about Munros, just in case you're not aware, is that, yeah, we're accountants and business advisors here in WA. What that means is that we do tax returns for individuals, trusts, partnerships, companies, you name it, self-managed super funds, we do it. And we prepare financial statements for them. But we also help people as they're going into business with due diligence reports and business validity deep dives on whether or not they're buying a good business. We also have a number of farming clients and we exceptional service there. And something that we're very proud of is our succession planning in that space. But we also do help with succession planning outside the farming sector. And we're known as Australia's go-to for cryptocurrency and blockchain tax-related matters. So generally overall, we love to help people save tax and achieve better business solutions. We're pretty proud of our Google review rating, which we think demonstrates the fantastic service that we provide. So I've just put up there a select number of Google reviews. There's much more on Google if you want to have a look. But, you know, let's focus on today's session. Today's session is about tax planning and specifically the steps you can be taking now in June to save your tax, and also steps you can take in the longer term to save tax. So the way it's going to operate is that Simon's going to run us through some of the more recent government stimulus measures out there. Ben's going to touch on the health checks in your business and the tax planning that you can do regularly year to year, and particularly this time of year. Mike's going to focus on a lot of the longer term structuring matters, and Christine's going to bring us home with the superannuation strategies there. And then we're going to have a Q&A at the back end. We've got about three pre-submitted questions. We'll run through those. And then throughout the webinar, I do encourage you to use that Q&A button to submit any questions you have, and we'll do our best to answer those questions throughout the webinar. And of course, the ordinary disclaimer that needs to be said. Obviously, we're not taking into account your personal circumstances during this webinar, so it's just general in nature information, and should you need tailored advice, please come and speak with us. Yeah, and I suppose, like, you know, why are we putting this on? Of course, we would love you to come on board as a client at Munros, but it's really about imparting as much information and knowledge as we can onto you so you can make smarter tax decisions. So having said that, if your current accountant isn't having these conversations with you, I would encourage you to perhaps have a think about making the switch to Munros. All right, so what is tax planning? Really, it's about organising your affairs to legally minimise your tax. And when we're talking about legally minimising tax, we have to think about what are your affairs and how can they be minimised with tax. But, you know, we also do, as I point up on there, have to think about the commercial reality of things and what can actually be achieved. Now here at Munros, the Munros way is to always work as hard as we can for our clients to minimise their tax, but certainly not go across the line and breach the law. So we're doing everything we can to work for you, and also give you the peace of mind that it's all okay with the ATO. So what does that mean? That means that we prepare a smart tax plan for our clients this time of year. And what that is it takes into account the financial position of the business to now, the year-to-date profit, which has definitely been impacted by COVID-19 for a number of businesses, their projections for the rest of the year. Once we've done that, we'll have a think about what strategies can be implemented now. And that's why it's important to get these this done in early June, because some of those strategies do take some time to get it through. And then we can give you a bit of peace of mind by giving you a 12-month calendar on your tax payments that are coming up. And then lastly, before I hand over to Simon very shortly, is I thought it worthwhile mentioning that you might want to consider upgrading your bookkeeping system this time of year, so you can have a fresh, brand new, top-of-the-line bookkeeping system up and running on 1st of July. So that's something else that we're helping a few clients with at this time. Okay, so up next we have Simon. Before I introduce Simon, I thought we should run a poll here today. I'm just launching that poll now. It's about the JobKeeper. Simon's going to run through the government stimulus measures, and one of those is the JobKeeper. So yeah, if you wouldn't mind just jumping on there and answering that, I'll just keep that open for a few more seconds. Thanks everyone for answering that. Fantastic. Let me wind that up and share the results with you. So there we have quite a few here today who are claiming JobKeeper, and they've already received their first payment. That's great. If you're not too sure, if you're out there and you're not too sure about it, I very much suggest you get onto it immediately, because deadlines are coming up. And hopefully those who are saying no, no, they're not claiming JobKeeper, it means that your business isn't impacted and you're doing very well. Okay, so Simon's the managing director here at Munros, and I was talking to Simon last night. Oh, Simon, you know, why do you do what you do? He says, I love helping people. So I thought I'd put that up there for him. So I'm just going to flick on the video so Simon can give you a nice wave.
Hey.
There we go, Simon.
Yeah, thanks, Drew.
Get in a bit better view there. And yeah, away you go, Simon.
Can I start? Right, I'm away. Good on you. Thanks, Drew, and good evening, everyone. I hope this webinar finds you well, wherever you are. Yeah, so as Drew mentioned, I'm going to talk about the tax implications of and planning opportunities around the government stimulus measures announced in connection with the COVID-19. Now, the government, you may have realised, is throwing a fair bit of money out there to business, although it's fair to say not as much JobKeeper as they originally thought, but still there's quite a substantial amount being thrown out there to businesses. So I reckon you would have already heard a lot, certainly in the media, about the JobKeeper scheme. And essentially what it is a subsidy payment of $1,500 per employee per fortnight, and that's set to run until early October 2020. And I've got to say, here at Munros, we've just been flat out with dealing with businesses in firstly determining their eligibility to the scheme, and then of course also lodging the first claims for April, and we're seeing quite a few of those come through, which has been great. And if you do need more detailed information on JobKeeper, we have produced a very good booklet, well, I believe it is anyway, on JobKeeper, and you're more than welcome to download that from our website. And as per the slide, enrolments are still open, but certainly until the end of May, if you wish to enrol and make claims for the months of April and May. So you need to get onto that pretty quickly. Note, it's not just employers who can claim. Business being carried on by a sole trader, partnership, trust or company can still qualify and claim JobKeeper even if they haven't got any employees. Simply put, a claim can be made for a person who is not an employee as such but works in the business, and that would be either, say, a sole trader, a partner in a partnership, a beneficiary of a trust, or a director of a company who isn't being paid. So, and yes, as per the slide, the JobKeeper subsidy is going to be assessable for tax in your business tax return. And what I would suggest here is it's not used as a measure of your turnover, and there's no GST applicable. So for those of you who are doing your own bookkeeping and maintaining your software, make sure you put the not applicable code on those payments as they come in, so they don't get reported as turnover and don't get reported in your business activity statement. So moving right along, the other generous initiative they've announced was the cash flow boost, and this is one of the early announcements and is proving very handy for businesses that employ people. So for the PAYG withholding businesses, employers with a turnover of less than 50 million, and that's applying to most of our clients here at Munros, it is delivered as a credit when activity statements are lodged. We've already seen these coming through. There's a minimum credit if you're reporting wages and tax withheld of $10,000, and you can get up to $50,000 credit, which is essentially equal to the PAYG withholding tax from your employees' wages that you report between March and June 2020. So 10 to 50 grand, minimum of 10. So if you only withhold $1,000, you're going to get the minimum of 10. But if you withhold anywhere up to 50 grand over the next 3 months, or from March to June, you'll end up getting a credit of up to 50 grand. And the other real kicker there, or bonus, is that you'll also receive whatever you received up until June 20, you'll receive the same amount again between July and September. And so effectively, you would have may have heard in the media, you get a minimum of $20,000 over the 6 months up to $100,000 credit. So that's very, very handy. And as indicated in the slide, the receipt of the cash flow boost is non-assessable for income tax. So that's another bonus. And the credit is automatic. So it's really nothing for us to do or you to do, really. Once you lodge your BAS, the ATO has a look at it. It gets processed by the ATO, and when the activity statement gets lodged, and you'll end up either getting a credit or even getting a refund paid through to your bank account, depending on the GST positions, etc., in your BAS. With the profit and loss statements and stuff and how you're going to report it, even though it's not accessible, I think for most of our clients, we'll end up leaving it in their profit and loss statements, and we'll simply write it back on the tax return as an add back. Once again, GST code for those reporting it in their accounting software. GST code not applicable. We don't want to include that for turnover, and also we don't want there's no GST collected on the boost. ADO deferrals. So the ADO has been pretty busy announcing a number of what we call temporary administrative measures as a result of COVID-19. And I reckon some of these will be of interest to you. Firstly, our team here is having a lot of great success in getting any interest and penalties remitted on taxpayers' accounts. So they're pretty lenient at the moment, the ATO. And so if you need any help in getting any interest or penalties remitted, then feel free to give us a call. But you should have some success in getting those remitted. On top of that, the ATO has announced a deferral of payment of income tax and fringe benefits tax until September 2020. So if you've got a tax bill coming up now, you've got one outstanding, then it's pretty easy to get that extended until later on in September. And what happens after that, time will tell. And they've also said that they'll stop interest accruing on those bills as well. So once again, if you do need any assistance or help in trying to get those extended, then feel free to give us a call for help in that area. I've written down there PAYG instalment variations. So that's quite a good option to save some cash. So if you choose to amend or vary your PAYG, so this is tax that you pay towards your expected tax bill, then you can vary those down. So a lot of us will be paying our March instalments now. And the kicker there is also that you can claim back a refund for any PAYG that you might have already paid during the year. And what the ATO have said is that normally you would get penalised if subsequently you ended up having to pay tax because you varied your PAYG down too much. But what they've said is they won't be charging penalties or interest if we get the variations wrong. So that's a pretty clear indication, particularly for businesses. If they want to generate a bit of extra money in their business because of the uncertain outlook with this COVID, then you can certainly take advantage of that. A very good cash flow option. Just bear in mind that if you do vary down your PAYG tax, you will obviously, and you do end up paying tax, of course, you are just sort of deferring that tax. You may well have a fairly big bill when you go to lodge your tax returns for 2020, which won't be due until more than likely March 2021, particularly if you're with a tax agent. So that's all very good there. instant asset write-off. Yeah, this is quite good. The government announced fairly early on some incentives to get business to invest, in particular in the June 2020 quarter. They came out pretty early with this. I don't think they'd realised the extent of the shutdown due to COVID-19. But in any case, it's there, and it's quite a good incentive. So firstly, there's an instant asset write-off. It applies for asset costs, assets purchased from 12th of March to 30th of June 20, up to $150,000 in cost. So that's up from $30,000 with the existing. And it's worth pointing out, at the moment, it's legislated to drop to $1,000 from 1st of July. So that's for small business enterprises. So, there's a pretty good incentive to get your money spent before 30th of June if you need to, obviously. It applies to new or second-hand purchases and for businesses with a turnover of up to $500 million. And I can confirm that applies to most of the clients here at Munros as well. The point I've made there, it's got to be installed, ready for use. So to claim, it must be installed and ready for use before 30th of June 20. So if you really want to spend some money, get onto it before 30th of June, and make sure it gets installed before 30th of June. You really need to get that done and ready to claim it under these provisions. Just on the small business clients or small business entities, if their general pool is less than $150,000 balance at 30th of June 20, then they're able to claim the balance of that as well. So that's quite a good tax planning initiative. And just bear in mind, there has been had a few inquiries about buying cars before 30th of June in the businesses as well. Yes, they will qualify under this provision, but just bear in mind there is a cost limit on cars. 57,581. So that would be the limit of the tax deduction. So just bear that in mind as well. Accelerated depreciation. So there was another initiative announced as well. This one, as indicated in the slide, 12th of March 20, but it goes to 30th of June 21. So we actually get an extra 12 months on this one. You get a 50% write-off of the cost of the asset, and the remaining 50% goes into your depreciation pool. So I've mentioned there for small business enterprises, they can deduct 57.5% of the asset purchase price in this year. So that's a bit of a bonus. Larger entities, not SBEs, can deduct 50% and the usual depreciation on that. So a couple of points: it must be brand new, got to be new assets, no second-hand ones for this one. Asset must be first used or installed, ready for use between those two dates that I've indicated. And in order to apply this provision, you must have contracted to buy after 12th of March 20. So if you'd ordered something, say a tractor or something, in February for delivery in April, then this particular provision would not apply. So you need to make that commitment to buy after then. And that's pretty much it. That's me done. I'll hand you back to Drew. Thanks for your time.
Thanks very much, Simon. That was fantastic. Great information there. I'm going to introduce Ben Paul here. So Ben's a principal here at Munros. He's a specialist in business performance management and tax minimisation strategies. So Ben, I'm just going to turn on the video so you can give everyone a nice wave.
Thank you, Drew. Good evening, everyone. Welcome.
All yours, Ben.
Thank you very much. As Drew mentioned, the next part of the webinar I'll be covering is just to do with some very common tax planning strategies, which we put to use quite often to achieve the best tax result possible for our clients. Now, firstly, quite a popular technique is to do with the timing of income. Usually that's through the invoicing system, so obviously relatively easy to adjust that. It's generally advantageous to defer as much income as possible to the following financial year if you're able to do that, but of course, you should be considering the specific circumstances of your business, in particular the cash flow needs of the business. Obviously, deferring invoicing will have a bit of an impact on the business cash flow. Also, if there's any capital gains, taxable capital gains, that is then a planning technique there is to avoid adding any extra revenue to the capital gain, so to avoid paying a higher rate of tax. Another technique for minimising tax is to do with the timing of expenses. Now, generally, these will be brought forward to the current financial year. It's particularly useful for those expenses which will be expected to be incurred in those early months of the next financial year. So July, August, or possibly September. So if it's possible, bring those forward into the current financial year. So the tax benefit from those expenses is obtained 12 months earlier. And just lastly on the slide there, a common expense to bring forward to before 30th of June as well is the June super. So as you may be aware, it's not actually due for payment until the 28th of July. But if it is paid before 30th of June, then the tax deduction will be received in that year. Moving on to end of financial year stock take. So this obviously won't necessarily apply to all businesses, but simply businesses which are carrying inventory for the purpose of resale. There's 3 alternative methods there listed on the slides. So the first being the cost valuation method, market selling value method, and the replacement value method. So generally speaking, you'd want to use the lowest or the method which produces the lowest valuation. That's purely because the closing stock value gets added to the taxable profit for the business for the year. And a very important note, actually, a very handy tip is that different methods can be used for the different stock items. So you can basically pick and choose whichever produces the desirable result. Just lastly there as well, just a note on stock obsolescence. So it's a handy tip to have in mind that if there are any items of stock which have become obsolete or worthless, just make sure that there's no value for those rolling through to the end of financial year stock take figure. End of financial year is also perfect time to review the business's asset register. So for small business entities, if you're not already doing so, you should consider using the pooling which is available. That'll make sure you're getting the highest depreciation claims possible. Also a good idea to identify any assets which maybe no longer exist or don't have any value anymore, and they can be scrapped or written off. Again, end of financial year, also the perfect time for just reassessing some of the assets' effective lives, if that's appropriate. The result of that may increase the depreciation deduction, which can be claimed for the year. And just lastly there on the slide, a tax depreciation report. Now, what they are is a special report prepared by quantity surveyors and in relation to property purchases. So if you have purchased a property during the year, it's definitely worthwhile considering whether a tax depreciation report would be worthwhile obtaining. Now, a few other tips in the lead up to the end of financial year. So small business entities, they're eligible to claim prepayments as a tax deduction, provided the service period or the period that the prepayment relates to is 12 months or less. And for any businesses which aren't an SBE, the regular prepayment rules will apply, which basically require the prepaid portion to be added back. Moving on in relation to staff bonuses. Now, these are generally only deductible when they're paid in cash to the staff. There's only very specific circumstances where deductions can be claimed for bonuses which have been announced or accrued at year end, but not actually paid in cash. So the tip here is, if you're intending to pay staff a bonus, then perhaps consider bringing that forward and paying it before the end of the financial year, just to make sure we get that deduction through in the current financial year. Now, lastly there, unfortunately, bad debts, they will happen, hopefully not too often, but the tip here is before the end of financial year, just to review all the unpaid invoices that are outstanding. And if there's any there that aren't going to be recovered, they should be written off, or unlikely to be recovered, then they should perhaps be written off. Just make sure you do that before the 30th of June to make sure you get the tax deduction for that bad debt write-off. Now, something that we've seen happening quite a bit in recent times is the refinancing of loans. Presumably that's to do with the lower interest rates which are available at the moment. So obviously best advice there is to ensure that the bank is giving you their most competitive rate. That'll benefit by way of reduced ongoing interest costs, of course. Now, with regards to prepaying interest, there's an opportunity there to potentially pay in advance up to 12 months of interest expense on a deductible loan to bring forward that tax deduction. Generally speaking, this is only used as a bit of a backup tax planning tip, or tax planning mechanism, if there's no other suitable alternatives or options. And just finally, in relation to loans, generally there's borrowing costs, which by their nature will be capital. These are such things as loan establishment fees or perhaps some legal fees. So capital costs are, while they're not deductible specifically, there's a special rule which applies for borrowing costs to allow them to be claimed over either 5 years or the length of the loan, whichever is the shorter period. And just to move on to some final tips for minimising everyone's tax. The first there is on car logbooks. We found these to be very beneficial actually, particularly for newer type vehicles which have a higher business use. So commonly we see tax deductions for these vehicles in the range of about $8,000 or $9,000. So that well and truly trumps the alternative method which is available for car expenses, which is a cents per kilometre method. Now, home office expenses, recently the ATO's announced an increase to that allowable rate that can be claimed. So that was directly due to the increase in everybody working from home as a result of the virus lockdown. And just finally, if anyone is considering charitable donations coming up, so basically if you're planning to make a donation, it might be advisable to do so before the 30th of June to make sure that deduction can be claimed in the next tax return which is lodged. And just on a little bit of a side note in relation to charities, specifically if anyone has a charity as a beneficiary of their will, just be mindful that when funds flow to a charity through a person's will, there won't actually be a tax deduction available for those funds. So that concludes my portion of the webinar. So I'd like to hand you back over to Drew.
Thanks very much, Ben. Fantastic information there. Particularly around, I'd like to say around the stock take, although probably a pretty simple thing sometimes, there can be actually a lot of tax savings there if you use the methods correctly. And also on the loan refinancing, I know we have a great question that was pre-submitted earlier. So we'll be answering that at the back end of the webinar. So we're about to hand over to Mike, but before we do, I thought we'd run another poll here to help Mike out a little bit, because he's going to be talking about some concessions that small business entities can have, particularly around the longer term. So I thought, why not find out what the size of the entities that you're running, people here on the webinar today, just so Mike can really tailor his advice to your circumstances. So we'll just keep this one open. If you wouldn't mind just getting in on that poll before we wrap it up. There we go. Your votes are coming through. Fantastic. Thanks. And done. Wrapped it up. Sharing the results with you. So we have a number of, I suppose, the smaller end, the micro businesses here, perhaps startups going on. A number in the 2 to 10 million, 2 million. Yeah. So most of us here today are small businesses. So that's fantastic. So let me just close up that poll and introduce you to Mike. So Mike here he's a director at Munros, and he's the man that can help you with everything business related, everything tax, wealth and knowledge. Fantastic experience he has. So Mike, give us a wave. Your video's on. Say hello to everyone.
How you're all going?
All right, fantastic, and away you go.
Right. Thanks, Drew. And my first topic today is about farm management deposits, which is really aimed at our primary producer listeners, if we have any out there. So an FMD is like a term deposit, but the benefit of it is if you meet certain eligibility criteria, if you put money into one of these, then you can actually claim an outright deduction for it, up to a total amount of 800,000. But the catch is when you withdraw it out of the FMD, it is assessable income to you. So leading up to 30th of June, it's a good idea to perhaps prepare a tax estimate to see what tax savings there might be by either making a contribution to a FMD, or alternatively, if your cash flow is running a bit short and you have already got monies in FMDs, then having a look at the tax effect of pulling that money back out. Moving on to Division 7A. So for those of you who don't know, Division 7A is a Tax Act provision whereby loans made from companies which deals with loans made from companies to shareholders or their associates. And pretty well, money can only come out of companies in three ways. The first one being salaries, the next being dividends, and then the third really being loans. Now, if you pull money out of the company via a loan, then you really need to have it under, in order to comply with Division 7A, you need to have it under a written loan agreement. You need to make minimum annual repayments each year, and interest must be charged at the ATO benchmark rate, which is currently 5.37%. And it also is required to have a maximum loan term, which for unsecured loans is 7 years. So loan repayments, these minimum loan repayments that I was talking about, they can be paid either by the company declaring out an assessable dividend to the shareholders, or alternatively, the persons who borrowed those monies paying back the monies in cash. Now, the first loan repayment isn't required until the year following when the actual loan is made by the company. And there is a bit of a window of opportunity in order to fully repay that loan before either the tax return is due to be lodged for the company, or before the company tax return has actually been lodged. And you can just see there that there's normally smaller companies were required to lodge their returns by the 15th of May, but this year with COVID, the ATO COVID measures, that's been stretched out a little bit further to the 5th of June. So allowing you a bit more time to either declare a dividend to repay those loans from the prior year, or put some cash back into the company. Now, in terms of, as I said, one of the main ways is to pay these loans is by declaring a dividend. So it's important to make sure that you've got sufficient franking credits in order to pay such dividends out as fully franked, which obviously reduces the incidence of tax at the individual shareholder level. And if you haven't got sufficient franking credits, then it's probably a good idea, if you can, to find some cash to put back into the company in order to make those minimum Division 7A loan repayments. And if you are making the repayments via declaration of dividends, it's important to also make sure you've set aside some money for the tax. So just probably elaborating on that a bit further, when a dividend comes out from a company and it's fully franked, then the ultimate shareholders are taxed on that amount of the franked dividend plus the grossed up franking credits. And then they're subject to tax at marginal rates on that total income. But they do get a credit for the company tax rate, which is either a 27.5% or 30% credit. But obviously if their marginal tax rate's higher than that rate, then there is what's called top-up tax. So it's important to make sure you've got some money set aside for that potential top-up tax liability. Leading into the new financial year, it's a good idea to do a bit of a health check of your business and the structure that you're carrying it on in, and just making sure it's fitting your current needs still. You know, have you outgrown that existing business structure? So that might be from the point of view of income splitting, asset protection, or even access to what is known as the small business capital gains tax concessions. So there is CGT rollover on changing your structure in certain circumstances, although you've just got to bear in mind stamp duty implications as well, as because generally there's not as good as concessions there on a reconstruction. Next topic is to do with trusts and trust distributions. So it's important that if you're carrying on a business through your family trust or holding investments in a family trust, that you actually make your trustee resolutions by the 30th of June 2020. So in terms of determining who you're going to distribute the income of the trust to and actually document that in writing. Otherwise, the trustee can potentially be taxed at 47% on that taxable income of the trust. And you also need to report to the ATO any the TFNs of any new beneficiaries you might be distributing to in respect of that year, and that reporting needs to be done by the 28th of July 2020. So when I'm talking about new beneficiaries, this could perhaps be your children who are becoming adults during the year, whereby they become a bit more tax beneficial to you in terms of splitting income. Or there perhaps might be a new son or daughter-in-law who's coming into the family or has come into the family during this current financial year. And you might be comfortable in distributing income to them in order to split the income and take some benefit of lower marginal tax rates. Or alternatively, a new beneficiary might be a new company or trust that you've recently added into your group. So if you don't do this TFN reporting, then the trustee is technically required to withhold 47% of any distribution made to that new beneficiary. Now, the next point there is to do with, perhaps whether it's worthwhile setting up a bucket company. So pretty well the way a bucket company works is that you have, say, your family trust. The family trust will distribute to, say, the individual beneficiaries of the trust using up all their lower marginal tax rates. And then if you've got taxable income to split after that, you might look at hiving it off down to a bucket company, and whereby that bucket company is either taxed at a 27.5% or a 30% tax rate. And then you can see there on the slides, there's some legislated tax rate changes coming up in the 2024 financial year. And there's also some in between in 2023 as well. Those first ones, basically, the 32.5% tax bracket applies from 45,000 to 120K before it then again goes up in 2025 financial year. So with a bucket company, you've got the potential to put money into that bucket company or have what's called an unpaid present entitlement with that bucket company from the trust. And then again, that would be under like a Division 7A loan agreement, which I was talking about before. But then the dividends, in order to repay that Division 7A loan made, are spread out over a number of years, and therefore you might be able to spread some income out into later years in order to benefit from those legislated tax rate changes that are occurring. Or alternatively, you might have perhaps some, children turning 18 in the next few years, and again, looking at spreading out that income in order to try and split it more effectively. Next point here is to do with the small business capital gains tax concessions. So these are fantastic concessions if you're eligible for them. So what it is if you sell an asset that's used in your business, such as goodwill or even a business premises, then you can potentially reduce any capital gain on such a sale of an asset down to nil. But there are a number of eligibility criteria in order to access these concessions, including that if your business turnover is above 2 million, your net assets need to be less than 6 million. But the good news here is that from that 6 million net asset figure, it does exclude your main residence as well as your superannuation. So therefore, it's a good idea that if you're looking at selling your business assets shortly, that and if your net assets are around that 6 million, then it's important to plan ahead and try and get down below that 6 million limit. So you might do this by using your available super limits to contribute more to super, which Christine will cover a bit more later on. Or if you're feeling generous, you could look at gifting some money or assets to your children, although bearing in mind there might be some tax or other implications on doing that. Or alternatively, you might look at even upgrading your main residence if you need some new digs. You might look at bringing forward the decision to upgrade your house if you've got an impending business sale and you want to get your assets down for the purposes of these small business concession tests. Testamentary trust, look, it's around this time while tax is at the forefront of your mind. It's a good idea to get out your will, dust it off, have a look, make sure it still meets your current wishes for who you wish your estate to go to, and also to make sure it's drafted in a tax effective way. So the inclusion of a testamentary trust in your will is, I've seen it save massive amounts of tax over the years. So a testamentary trust is a trust created via a person's will, and it works much the same as a family trust. However, it's got the major tax benefit that children below the age of 18 are taxed at ordinary marginal tax rates. So example, they get the first 18,200 tax-free, etc. Whereas this is as opposed to a child below the age of 18 getting income distributed to it from a family trust, whereas such minor children are pretty well taxed at 47%, at a 47% tax rate as soon as their income goes above $416. So there can be massive savings with for your beneficiaries of your will if testamentary trusts are in place. So this is particularly the case that if your kids, perhaps by the time of your passing, are all pretty well set up in their own rights and earning decent income, whereby if your inheritance to them can be streamed into a testamentary trust, and then they might have children or grandchildren at that stage even who they can split the income on their inherited assets on. Testamentary trusts also have some asset protection and safeguarding of asset benefits as well. But yeah, look, well worth including in your wills generally. My final slide is to do with keeping cost base records. So this is more aimed perhaps of those of you who have holiday homes or second residences, or perhaps if there's any country listeners, they have the Perth unit or house or something which they use as their private residence, or for the personal use. So you can only ever have one main residence for capital gains tax purposes at any one time. So it's important for any other properties, houses that you have, which you do use for your personal purposes that aren't rented, etc., that you actually keep your cost base holding cost records for them, because keeping a record of these costs will reduce your future capital gains tax implications on the sale of those particular houses, etc. So what I'm talking about holding costs, I'm talking about rates and taxes, repairs and maintenance, improvements. So again, keep a record of all these. And also, even if it's your main residence but you're considering moving into another place, but leaving that perhaps residence for your kids to live in or something like that, Again, you can only ever own one main residence at one time, so it's important to keep a record of all those holding costs, because when you eventually do sell those houses, it will reduce any CGT implications. So that's it for me. So I'll hand you back to Drew. Thanks, Drew.
Thank you very much, Mike. All right, we're about to introduce Christine, who's going to be one of the last speakers here this evening. But before we do that, Christine's going to touch quite upon the superannuation. So we thought we'd put up our third and final poll for this evening, which is it's a nice simple one, yes or no answer. Yes, if you're using extra super contributions to save yourself tax, and no if you're not. We've got the votes coming through there, fantastic, and I'll just finish them up, share the results. So it's slightly more on the yes side, using up extra super contributions, so that's fantastic to hear. Those who are not, it's something to consider, whether or not now, just consider that in the future, particularly taking on board what Christine has to say coming up. So Christine is a director here at Munro's, a very personal one, I like to say, and very much family orientated advisor. She likes to get in there with the family and make sure that they're set up for the long term to save tax and achieve what they want. So Christine, if you don't mind, I'm just going to chuck on the video so you can say hi to everyone.
Hi, good evening, everybody.
And away you go, Christine.
Thank you, Drew. All right, tonight my topic will be on superannuation contributions. And yeah, I'll be focusing on reducing or minimizing your tax by making deductible contribution into your superannuation account in a particular year. Obviously, this got to be, obviously your individual circumstances got to be considered to determine whether that's a suitable strategy. So for example, as you get closer to retirement, perhaps this strategy is more attractive compared to some of you who are in the early 30s and about to buy your first home, and other family situation like number of children and private school fees to pay and your personal debt level as well. On the webinar, as it's on tax planning, I'll be focusing on the concessional or deductible contribution. So most taxpayers will have concessional contribution limit of $25,000. So what goes towards this 25K? So for salary earners, the employer contribution, the contribution made, the compulsory superannuation guarantee made by the employer is counted towards this 25K limit. So as the salary sacrifice that we've got on the slide there, as well as the voluntary member contribution. So what is the attractiveness of this concessional contribution? So when this contribution is received by the super fund, it is taxed at a flat rate of 15%, which can be a lot lower compared to the highest marginal rate of tax of 47%. So let's go straight to the salary sacrifice and into an example. Say for a salary earner who's getting 150K in salary per year, they may go into an arrangement in advance with their employer to sacrifice, say, $10,000 of their salary into superannuation account, so that $10,000 will be taxed at 15%, while having the 140K rather than the 150K originally being taxed at the marginal rate of tax. Under this example, the tax savings will be around $2,400. And for salary earners, making contribution into super, maybe making deductible contribution into super, can be by way of voluntary members contribution, which I reckon is a more flexible option, because the employee can determine how much and when to contribute into their super account. Say probably that, say in the month of June, they might want to make a one-off contribution, but keep in mind of that limit, obviously. And the voluntary members contribution is also available to non-salary earners. So for those taxpayers having a capital gain income or larger investments income or family trust and trust distribution, can use this voluntary members contribution to minimize their tax. When you're using this type of contribution, you've got to make sure that you've got documentations in place prior to lodgement of your tax return. And some superannuation members who's got an account with the good old Gatsby Westate or Gold Super, they may not be subject to this 25K limit, which means they can actually contribute more of their salary towards this superannuation account. And the additional benefit for this type of super account, when the contribution is received, it's not taxed. As the way the super fund account works, it's only taxed when the member is in a position to get the benefits out when they retire. The next contribution strategy is the new one, which is the catch-up or the carry-forward concessional contribution, which was only introduced from 1st of July 2019. So that 25K concessional contribution limit, if it's not fully utilized in a particular year, the balance can be carried forward up to 5 years before it expires. This strategy, however, is only available for superannuation members with a total superannuation balance of less than $500,000. So if a taxpayer is having a larger than usual income, say from capital gains on sale of property or shares, or when the business has had a bumper year, then you might be able to use this one to minimize your tax. The other strategy that can be available is the contribution reserving strategy, which is slightly the other way around from the carry forward contribution. So instead of borrowing prior year's concessional contribution limit, the member is actually borrowing from their next year's concessional contribution limit. So you can actually put in up to $50,000 in deductible contribution in a particular year. Again, it's benefiting taxpayers with a large one-off income that will not repeat in the future because you'll be borrowing from next year's limit. Means you won't be able to make that same contribution next year. The good thing, the 500K total superannuation balance doesn't apply under this strategy, but be very mindful as it's got its strict implementation rules, and for non-superannuation for self-managed superannuation fund members, they might be able to utilize this strategy, although they must check the deed. But for non-superannuation fund members, they've got to check with the trustees if this contribution type is available to them. The next one is on Division 293 tax. So the 25 concessional contribution limit, the 25 concessional contribution, when received in the fund, it'll be taxed at that 15% flat rate. However, for high income earners with adjusted taxable income of more than 250K, the Div 293 levy an additional 15% tax on the concessional contribution. So all up, the tax can be as high as 30%. But still, it is a better option compared to the highest marginal rate of tax of 47%. So planning is important. Say if you have a family trust with a few beneficiaries, with careful consideration, we might be able to avoid triggering this Division 293 tax. And we're moving on to the downsizer contribution. This is quite new as it only started on 1st of July 2018. And it's only available for superannuation members aged 65 years or older and have sold their main residence. This strategy is not giving any tax deduction, but it can boost up your superannuation fund balance and be used to rearrange your superannuation fund estate planning strategy, which I will cover a bit later under the recontribution strategy. So how much can you put in under the downsizer contribution? It's up to 300 grand per member. And the attractiveness from applying this strategy, when it's received by your super fund, it is not taxable and it will go towards your tax-free component. And you don't have to acquire another replacement residence. And even if you acquire one, it doesn't have to be smaller in size or lesser in value. And say if the property that you sold was only registered in your name, provided your spouse meets the age requirement, your spouse can also contribute up to 300 grand into his or her superannuation account. So all up, you can contribute up to 600 grand from utilizing this downsizer contribution. There are other restrictions to follow before accessing this strategy. Ones that are worth mentioning: the home must be owned by you or your spouse for 10 years or more prior to the sale, and the contribution must be made within 90 days of receiving the sale proceeds, which is usually settlement date. The next topic will be on pension. Okay, commencing a pension is optional, so you can keep your superannuation benefits in accumulation phase for as long as you wish, but you can only access your super fund benefits when you've met one of the conditions of release, and usually that's retirement, like turning 65, or if you are between 60 to 65, you've left your current employment arrangement. So what's the main incentive of starting a pension? When you commence a pension from your superannuation fund account, the investment income derived by your super fund that's used to support your pension will be tax-free. So this includes dividend income, interest, and also capital gain. So no tax at all within your superannuation fund account. And furthermore, if you are a pension member of 60 years of age or more, the pension fund, the pension drawdown that you're pulling out will not be taxed in your hands either. So if you've got a lot of investment income outside super, that's taxed at your marginal rate of tax. Where possible, you can try transferring those assets into your superannuation fund to reduce your taxable income, and having those investment income being derived in a super fund environment that's got zero tax zone. And for those who don't have much income outside super and need to retire, they will get the additional cash flow to fund or supplement their retirement income from having the pension from their super fund account. So there are other factors though before starting a pension, because it may have an impact on your settling age pension or things like Commonwealth Seniors Health Card as well, and also the additional cost from running a pension account. When you start a pension, you've got to take out at least your minimum pension entitlement at least once a year, and that minimum amount is determined by your age and your pension balance at the commencement or at the beginning of the financial year. And again, when you start a pension, it doesn't mean that you can't contribute into your super fund anymore. It is still possible, provided you meet the contribution requirements. The next one will be on the recontribution strategy. This strategy is only available when you've met the conditions of release and usually are receiving pension from your super fund. So this should be considered by superannuation fund members with larger balances who are planning to inherit that superannuation funds, actually the funds from within their super fund to their to their adult children. So this strategy is not going to give you immediate benefit, but then the whole idea is to rearrange your superannuation fund estate planning to save potentially massive tax on your demise. So a lot of people think that, you know, upon the demise, the superannuation benefits will go out tax-free. No, not necessarily, because our superannuation account made up of two different components, the tax-free component and the taxable component. From the name, the tax-free component, wherever it goes, whether that be to your spouse, which is your dependent, or to your adult children, it'll be tax-free. The taxable component, however, when it goes to your spouse, it'll be tax-free at that point. But then when it goes to your adult children, tax of around 15% at least will be calculated on the taxable component. So if you pull out your member statement and work out the taxable component of your superannuation account and multiply that by 15%, pretty sure you'll be surprised as to how much you'll be donating to the ATO upon your demise. So with the whole idea of this strategy, you want to minimize or eliminate the death tax by pulling out some amounts from your pension account to reduce the taxable component, and then put the withdrawn amount back into your superannuation account under one of the available contribution limits. Usually the common ones are the non-concessional contribution under the bring forward rule, or the downsizer contribution that I mentioned earlier, and the CGT retirement exemption that Mike covered earlier as well. So with careful planning and consideration, which can be over a few years towards retirement or turning 65, you may be able to convert a good size of your unwanted taxable component into tax-free component by using the cash flow within your superannuation account. So the last topic that I'll be covering tonight is on Medicare levy surcharge. Most taxpayers are paying 2% Medicare levy on their taxable income. So this surcharge is levied on top of the Medicare levy for taxpayers who don't have an appropriate private hospital cover and have income above certain threshold. And the levy ranges between 1% to 1.5%. So it can be pretty substantial. So the whole idea is to encourage taxpayers to take out private health insurance cover. And also if you have dependents, make sure that they're also covered under your policy. So if you anticipate to have a large income, do ensure that you have set up the appropriate private hospital cover for you and your dependents as early as possible. Or if you already have a private hospital cover, but are expecting an addition to your family, like childbirth or a new spouse or partner, please ensure that you report this event to your private health insurance so that your dependent will be covered from day one. And also, if you have older children who have been covered under the family's private hospital cover, but are no longer considered dependent, as an example, turning 21, but not studying full-time, your child may need his or her own private hospital cover. I do consider the Medicare levy surcharge situation pretty carefully, actually, for my family trust clients who have trust distribution and allocate a good size of the income to their young adult beneficiaries. So yeah, that's it from me tonight, and I'll hand you back to Drew.
Thanks very much, Christine. Brilliant. Yeah, so let me just flick on the video for everyone. Hi, everyone, again. Christine, can I just get the lovely clicker there? Thank you very much. Get the slides moving along. Fantastic. I just wanted to mention, we focused a lot about tax planning this evening, but I also do very much, and so does the team here, think and know that you need to focus on your vision and your purpose, particularly throughout these times. We're all being challenged at the moment with COVID-19. And then if you can focus on why it is that you do what you do, why you're making your investments, I'm pretty sure, I'm very confident that you can achieve the success that you need. So those who also are sort of new to Munro's, you might be wondering, what is Munro's purpose? And it's to help ambitious business owners and investors change lives for the better. So that's change lives for the better, however the business owner or investor feels it in their purpose. So whether it's for them, for their family, for their customers, we're here to service you and to help you achieve those goals. Some ways that we do it internally, and what our clients do and how we help them out is with strategic plans. So you want to be focusing right now on the disruptions to your business and the opportunities that are available in the immediate term, for example, in the next few months, the intermediate term over the next year, and then probably more likely over the next 3 to 5 years. So with that said, what I'm going to do is I'm just going to turn off that video again because we're just getting into the Q&A section here. But just before we get into the Q&A, the pre-submitted questions, and then I know that we have at least one question that's come through the webinar from Leisha. It's just to mention that yes, we are helping our clients and possibly yourselves with smart tax plans at the moment. Once again, it is very important to get onto these in the beginning of June because you're going to need to implement strategies throughout June. So if you leave it till 30th of June, you might get the plan, but it'll be pretty hard to implement. And then, yes, we have been recording the webinar this evening So Matthew, on the live stream, you'll be able to get a recording if you just message me and let me know. Otherwise, for those who are attending the webinar today, who have registered for the webinar, you'll get an automatic recording. Okay, so the first question is, that was pre-submitted, what are the most common mistakes you see small businesses make? Who would like to take that? Ben's going to take this one.
I'll take that. Yeah, thanks, Drew. Yeah, very good question, that one. I think it's fair to say most small businesses actually fail to get the necessary advice. So whether that be in regards to business structure or cash flow planning or tax minimisation, yeah, small businesses need good quality advice just as much as any other business, really.
Brilliant. Well answered there, Ben. So the next one is, I'm interested in the pros and cons of purchasing a company vehicle. I believe Mike's going to answer this one.
Thanks, Drew. Yeah, so look, it really, I mean, like we do, sorry, I'll start again. If you're purchasing a vehicle through a company or a trust, like you can look at claiming the GST if that entity is registered for GST. So that's up to the car cost limit, though, that Simon was talking about before, which is about 58,000, as well as you can only claim depreciation up to that limit. But the good news is, even if that vehicle has got no business usage and it's owned within a company or a trust, there's an assumed business usage in terms of calculating the FBT consequences. So you often find that the deductions for your depreciation, running costs and claiming your GST outweigh, particularly in the initial years, the FBT consequences of that vehicle. So there is often like a reasonable benefit of holding vehicles in a company or trust. And it also depends on your logbook as well. But yeah, it's a real number crunching exercise, but there can be some benefits in there.
Thanks very much, Mike. So this one's the scenario one, and this is about the loan refinancing that I mentioned earlier. It's about the tax deductibility of the interest. So I'll try and share this scenario with you. Hopefully that's come through. I'm pretty sure it has. So scenario one, we have property A, and before purchase of property B, there's a $300,000 home loan with a $100,000 redraw facility, and it's owner occupied that property. So what they're planning to do is purchasing property B, and then they're going to rent out property A. And when they purchase property B, they're going to use 100 grand of that redraw for property B. So we just flick back to the slides there. We've got the first question is, will the interest charged on the $400,000 on the investment loan, property A, be tax deductible? I suppose I can take this one. So it's all about what was the money used for. So for the redraw of the $100,000 there, that $100,000 is used for a home. And the home's not income producing, so the interest on that $100,000 will not be tax deductible. However, now the $300,000, which was originally used to purchase property A, it wasn't tax deductible when that was used as a home, but now that property is used for income producing purposes for rent, it will become tax deductible. So there's a bit of calculations to be had there. So the sort of answer is some of it is tax deductible. If we go to scenario two is instead what we're using here is we're using the $100,000 redraw to purchase shares or managed funds, and property A is rented out. In this case, all of it is tax deductible because the $100,000 for the redraw that was used from the redraw is to purchase shares, which can be income producing in the form of dividends. And the property A, once again, it's now used for rent, so it is deductible. Excellent. So that's our pre-submitted questions there. So what we're going to do is we're just going to pull up got one question here from Alicia. It is, can you please provide any advice regarding claiming home office car expenses if you don't earn enough to pay tax? Would it be effective to claim a JobKeeper if eligible, even if that puts you into the tax paying threshold? basically the sort of the answer is, yeah, if you can claim JobKeeper, I'll be claiming it, because yeah, even if it does push you into the tax position, after tax you're still getting more money than if you don't claim it. But if you are now above the tax-free threshold, yeah, you can go about claiming some home expenses or car expenses if they're related to your work or your business. So it's all about, for those things, the real advice there is to keep good records of what's happening, to substantiate your claims, and then you speak to your accountant about what you can claim and put that through. So thanks very much for submitting that question. And I believe we have something in the chat. So I can bring up the chat. I believe I saw a question there. Oh yes, Lynn asked, what is the income limit for the Medicare levy surcharge? Do you know the limits off the top of your head there, Christine? It's about 90 grand-ish, isn't it, for a single person, and 180, 190 grand for a family. And I think it's slightly adjusted if you have children as well.
Yes.
Correct.
Yeah, so it's important to keep that in mind, and also particularly if you've got investments there, because if you have a large gain in 1 year, that can throw you over. So if you are looking to realise a gain, it's important to keep that in mind. I think that was all the questions that were submitted. Let me just have a last check. Yep, as I mentioned before, Matthew, if you want to rewatch this, we'll make the recording available. Thanks, Sarah. Thanks, Carol, for thanking us for the webinar here. So once again, if your accountant isn't having this conversation with you, then I would suggest you and encourage you to make the switch to Munro's, because we're very keen to help get things right and help you save tax. So thanks everyone for coming on. Thanks everyone who's been on the live stream there, and have a great evening. Thanks.